Most investment advice out there, it's all about what to do, how to find the next big thing, how to beat the market. But what if that's completely the wrong way to think about it? In this explainer, we're flipping that entire idea on its head. We're going to explore the powerful concept of how not to invest, and why just avoiding the big mistakes might be the surest path to success.
And let's start with the quote that kind of kicked this whole philosophy off. When Charlie Munger, Warren Buffett's legendary partner, was asked if they were successful because they were smarter than everyone else, this was his answer. It is just a masterclass in humility. And it's the core idea behind a really powerful concept called inversion.
So what is this inverted idea? Well, instead of asking, how can I be a brilliant investor, we're going to flip it and ask, what are all the stupid things I could possibly do, and how can I avoid every single one of them? The goal here isn't to be a genius, right? It's just to consistently avoid making errors.
And here's the thing that really matters. What if the most reliable way to hit your financial goals isn't by making these incredibly brilliant moves, but just by consistently dodging the common, costly mistakes? It's a really simple shift in perspective, but as you're about to see, it changes, well, everything.
This whole idea is perfectly explained by this fantastic analogy from a famous paper by Charles Ellis. He called it winning the loser's game.
So in a loser's game, the outcome isn't determined by the winner's amazing plays. Nope, it's determined by the loser's mistakes. Victory isn't about scoring points, it's about not giving them away. And as it turns out, that's a perfect description of the world of investing for most of us.
Okay, let's use tennis to make this really hit home. The professional game? That's a winner's game. It's won by players like Roger Federer hitting these unbelievable shots that their opponent just can't return. But the amateur game, that's totally different. It's a loser's game. It's lost by players making what they call unforced errors, smacking the ball into the net or serving it way out of bounds. The amateur who wins is usually just the person who consistently gets the ball back over the net and just waits for their opponent to mess up. For 99% of us, investing is that amateur game.
So, if we're just amateurs playing a loser's game, why on earth do so many of us try to play like the pros? We get caught up in chasing this thing called alpha. Let's look at the hard data to see why that's such a dangerous strategy.
So alpha, all that really means is beating the market. It's the investing version of hitting that untouchable game-winning shot in tennis. It's what every professional fund manager gets paid millions of dollars to do. The real question is, can they actually pull it off? Let's start with just 1 year. Check this out. In any single year, more than half of all professional fund managers fail to beat the market. That's right, the so-called pros, with all their research teams and fancy computers, have less than a coin flip's chance of actually succeeding. Okay, but what happens if we stretch that out? Let's look at 5 years. Well, the picture gets way worse. All of a sudden, 83% of those fund managers are lagging behind the market. The odds of you having picked a long-term winner are just shrinking fast.
And after a decade, it's staggering. The failure rate is over 90%. I mean, just think about that for a second. If 9 out of 10 professionals can't consistently beat the market, what chance does an amateur have trying to do the same thing? You're playing a game you are almost mathematically guaranteed to lose.
Now, I know what you might be thinking, but what about the legends, like Warren Buffett? Well, the reason you know his name is because he's a unicorn. He is the 1 in a million exception that proves the rule. Trying to build your entire financial future by copying the rarest outliers in history? That's not a strategy. That's just buying a lottery ticket.
All right, here's some brutal math that really shows why avoiding those huge mistakes is so critical. If your portfolio falls by 50%, what kind of gain do you need just to get back to where you started? It's not 50%. You need 100% gain. One single, massive, unforced error can set you back for years, maybe even for good. Avoiding those catastrophic losses is, well, it's everything.
So, okay, if the goal is to stop making these unforced errors, how do we actually do it? Well, it really comes down to 3 simple but super powerful rules for winning this loser's game.
First, you have got to be incredibly disciplined with your media intake. Second, you must not interrupt the mathematical miracle of compounding. And third, and this is maybe the most important one, you have to master your own behavior. Let's break each of these down.
Okay, rule number 1 is all about the media you consume. So much of the financial news you see is designed to make you panic and do something right now. But listen, If your investment timeline is decades long, then what happens on some random Tuesday is just noise. The key is to consciously filter out all that daily panic and only focus on what matters for the long term.
The second rule, this is about protecting the single most powerful force in finance. And to really get it, let's use a quick story. Imagine two soldiers back in 1917. Each has $1,000. One of them buries his money in a jar in the backyard. The other invests his $1,000 in the stock market. Now let's fast forward 100 years. What's the result?
The money in the jar? It's still worth $1,000. But of course, inflation has basically destroyed its value. But the soldier who invested? His $1,000 grew to over $32 million. No, that is not a typo. $32 million. That is the almost magical power of long-term compounding.
And that right there illustrates the whole point of rule number 2. The market's ability to compound your wealth over time is like a force of nature. Your primary job as an investor is to simply get out of its way. Don't interrupt it by trying to time the market, and definitely don't panic during downturns. Just let it work its magic.
But all of this, it leads to the biggest hurdle of all, ourselves. This data is, well, it's truly shocking. Studies consistently show that the average investor underperforms the very funds they own by 3 to 4% every single year. How is that even possible?
It's possible because of one thing: bad behavior. We are emotionally wired to do the exact wrong thing at the exact wrong time. We chase investments when they're popular and everyone's talking about them. That's buying high. And then we sell in a panic when markets fall. That's selling low. We are our own worst enemy. Mastering this emotional impulse is the final and most important rule of all. So when you put all of this together, it leads you to this really profound conclusion about the entire challenge of investing.
Okay, so here's the big secret. Investing is basically a solved problem. We know it works. It's owning a diversified, low-cost portfolio for a very long time and just not messing with it. The challenge isn't trying to crack the code of the market. The real challenge is cracking the code of our own behavior. It's having the discipline to avoid those critical, unforced errors.
So the next time you feel that urge, to chase a hot trend or to panic during a downturn, just stop. And instead of asking yourself, how can I win? Ask yourself this inverted question: how can I avoid losing? Because mastering the art of not losing, well, that might just be the most powerful investment strategy of all.